morning, traders! Welcome to the Elliott Wave Street weekly update. I'm Juan Maldonado, and it's a pleasure to share with you some of our wave counts, and also I have some big news to this week. We are having on the inside the Elliott Wave Street membership the MACD Elliott Wave workshop. It's gonna be a fantastic workshop where we are going to talk about using the MACD to find the momentum and to find the end of the waves. So that's something that is going to be for the Elliott Wave Street members. No matter if you pick the Forex, the stocks, or the full access membership, you are going to get access to the workshop. It's going to be live. It's going to be on Wednesday, this Wednesday, May the 18th at 4:30 p.m. EST. Of course, it's going to be recorded and it's going to be posted in the members area. So you can access to this workshop plus all the membership benefits for just $19 or for the stocks, Forex, or the full access. You pick your plan and that's it. And we are going to talk in the MACD workshop about the price signals, the MACD signals, like this one, the divergence in the histogram, the divergence in the MACD, the crossover of zero, and of course the strategies by using all this information coming from the MACD and combined with the Elliott Wave. So it's going to be a fantastic workshop, and it's going to be included inside the membership. All right, traders. So let's start with the euro. Last week we were talking that the euro was likely to continue lower or to test this area, right? To move under this previous wave 3 to test the supply under this area. In case that we have a rejection of this area, let's say the price moving down and then immediately moving up, that will be a buy entry on this trading range. But instead, we got this big supply bar, a strong bear price action, making lower lows very easily until finally, actually this is a random level, the market stopped the sell-off and started to move in the opposite direction, but pretty weak as a corrective wave. As we can see, this is a bear flag on the euro. So this is good because it's the first time we are seeing the price since the drop doing some sort of accumulation process. So the market, let's say, is moving down and eventually it bounces, right? And creates some value, some demand, and then moves down here, moves below support, and rejects, and makes this reversal at the bottom. That could be entry number 1 on the euro. So that's what we are expecting here. I'm expecting for the price this week to test again this area, to move under this area. And this could be the first entry, right? Ideally, we should have another leg and another bounce, but not always is going to happen like that. So sometimes just with one leg here under the support after the big drop is enough, and from there it can depart. And some other times it makes the shakeout and makes another attempt. So that would be one way to trigger the trade. And the other way is going to be by waiting 5 waves up and 3 waves down. That's key. That's extremely important when we are using the Elliott Wave theory. When we are learning the Elliott Wave theory, we see an impulse, right? Of course, the price has been moving down, and we see an impulse. 1, 2, 3, 4, 5. When we are learning the technique, we see the 5-wave sequence in the chart, and we get very excited. We say, okay, that's the beginning of something fantastic. I'm just gonna wait for a discount in order to go long, because I have a 5-wave sequence, right? So the price starts selling off aggressively, let's say. Here is your invalidation point, and you start buying because the 5-wave sequence that you have on the left. And the price continues and takes out the low, and of course your stop loss that should be under the low, right? So you're gonna feel extremely frustrated. You're gonna feel, oh, that 5-wave sequence is a scam, right? That 5-wave sequence doesn't work at all, because I was seeing the 5-wave sequence. But if you continue studying the Elliott wave theory, because most traders, when they see this reality, they are going to get away from the Elliott wave theory forever, right? That's everything in trading. So if you continue working and understanding how this works, you're going to understand that the impulse is not an impulse for having a 5-wave sequence. The impulse is the impulse for having the 5-wave sequence plus a 3-wave sequence after that. That's the actual Elliott wave theory scheme. 5 and 3. And when you find your 3-wave sequence on the rejection, that's where everything becomes valid, not with a price action like the blue line moving down so fast. Right? So that's a huge difference in terms of application. And that's why most traders failed when they are learning the Elliott wave theory, because they are starting to accept wrong assumptions when learning the theory. So if you want to accelerate your learning pace on the Elliott wave theory, if you want to see how we apply these setups live every day, right, and the workshops and the Members Academy and all the things that we have around the membership, is something fantastic for your trading. And not only Elliott wave, also price action rules and institutional cycles and so many things that we talk on a daily basis on the daily analysis videos, right? So there are details like this one that I just gave you that I'm sure is gonna help you for your entire career. And with this concept, it took me years to get it. Right, these 5 and 3, I was part of, when I was starting, I was part of the traders trying to find a wave 2 because I have the wave 5, right? But this little concept is going to save you years of having a lot of trouble understanding the market cycles. All right, traders, the other one that we're going to check today is the fantastic S&P. The S&P, I would like to move to the weekly chart, and let's talk about the market cycle from here. So let's recap what we have been doing since the end of the pandemic. Here at this low, actually I found that the bias was bullish after this consolidation. Before, I was thinking that we were going a little bit more to the downside. So I started to accumulate my SPYs from there. I keep them, I still have them. I still have them, the accumulation that I did. And last year, if you have been following my work, what we have been doing, it was to use every of these corrective waves to add to that position, or to trade fresh if we were just swing trading or day trading, whatever, right? Then we got this strong sell-off and this rejection. Right here, I was thinking on this leg that we were already in the move up back to the high. I was thinking that we were going to see some sort of 1, 2, 3, 4, 5, A, B, C, and then the move up. That was my expected. So clearly this leg down was completely unexpected, right? I wasn't expecting this one, but when we trigger at the lows, because here I was able to add to the position again. Let me show you the area right here, right? I was able to trade there and everything. So this was unexpected, but it doesn't mean that unexpected wave is gonna bring losses. because we are looking for validation, right? So there are different concepts. But we have like 6 weeks in a row moving down with the candles closing near the lows. And then finally we got last week the first candle rejecting the lows. That is showing weakness in the supply, don't you think? Because the price was down and then we have some demand overcoming supply, and the candle finished higher than the low, actually higher than the 50% of that candle. So clearly that candle could be bullish, or not could be, is a bullish candle, right? So that opens the door for a possible reversal back to the previous high, or at least back to this area. I think we're going to check that on lower time frames, and I'm going to share with you my strategy to validate that information that we're seeing on the weekly. But let's say that this is the bottom, and we have a nice 5-wave sequence that is able to move back to the previous high. Let's say that happens, right? Because anything can happen in the markets. The market can crash or the market can move higher. We're talking about probabilities. But let's say that's the case, and at the end of the year, we have the price here at the highs, right? There we have to be extremely careful, because that could be the wave 5. As you can see, I'm very bullish with wave 1, 2, and looking for higher prices. But maybe that is not the one that is going to happen. What if this is a wave 1 of higher degree, and we start having the real market crash, moving back to the 2000 area, 2500 area, right? It's possible. So my point is that my main forecast, what I'm thinking that is going to happen on the S&P, is that we are going to have one more leg up. We're going to discuss if from here or maybe a little bit lower in a second, but more than that, here having a leg up back to the highs, and there we have to be extra careful, because if the price doesn't extend the wave 5 and it starts having a strong rejection or something, we will see the clues. We could be in the market crash, right? Probably, or maybe we just follow back here and we continue, right? That's possible as well. But my point is that we need to treat at market extremes. Imagine someone buying here at the top. It doesn't have any sense, right? We buy at the bottom, we follow the trend until the trend finish, but I don't think that is done yet. All right, so now that you get a better picture of what's going on, let's move to lower time frames, and we are going to talk about the internals. So this is the hourly chart. This is the 1 hour chart on the S&P. And I'm looking for a 5-wave sequence. The big question is this the bottom of the market? Right? So we can build with the Elliott wave theory a system to understand this behavior, right? So actually here will be better to have this as a 4 and this as the X. Okay, that's better. So look. So far we have 1, we have 2, we have 3, we have 4, and I'm looking for 5 today. So another move up. Look all the supply that we have at this area. Right? We have here a lot of supply. So the market is going to have trouble to cross that area. Especially the first time is likely just to absorb supply. But anyway, if we have wave 5, then we have another check at the bottom of the market. But remember, a 5-wave sequence is not enough. We need to have then a 3-wave sequence in the opposite direction in order to make valid that pattern. And that 3-wave sequence could be 50% of this move, could be 70, could be 30%. The key is that once we have the ABC, then we have a rejection, and that's going to be my entry this week. I want to go long on the S&P if this happens. On the other hand, if during this testing phase we start having some big red bars, let's say, of course we're going to make a lower low, right? So we are not going to buy because the setup didn't happen. I believe that the green scenario is the highest probability scenario. and that's where I want to go long on the S&P. So that's going to be the setup. Now I want to show you the website. Don't forget that this week we're having the MACD workshop included in the membership. We're going to have 2 fantastic live sessions talking about the MACD and how we can use the MACD with reading momentum, reading its signals, and understanding deeply how it works in order to validate the wave counts. So you can sign up for your trial to get access to the wave counts, the videos, trading plans, and the MACD Elliott Wave workshop that we are doing this week. Traders, please have a fantastic week. I'll see you soon. Take care. Bye-bye.